Welcome back to another enlightening episode of MH Knows or She Knows Someone Who Does, Unlocking Real Estate Secrets. I'm your host, Marianne Holt, and today we're embarking on a journey into the world of mortgages, grants, and loan programs tailored for first-time homebuyers. I am thrilled to introduce our distinguished guest, Elizabeth Parris, Senior Loan Officer at Movement Mortgage. With a wealth of experience in the mortgage industry, Elizabeth is a true expert in helping first-time homebuyers secure the home of their dreams. Elizabeth's expertise goes well beyond the surface, delving deep into the intricacies of mortgage approvals, grants, and underwriting requirements. She has been dedicated to educating and empowering new home buyers, ensuring their journey into homeownership is smooth and successful. Today, we're going to explore the essential aspects of mortgages, grants, loan programs with Elizabeth, providing you with valuable insights into the do's and don'ts during and after the mortgage approval process. Elizabeth Parris is not just a senior loan officer, she's a trusted advisor who has assisted numerous first-time homebuyers in making their dreams a reality. She's here to share her insights, wisdom, and actionable advice that could empower you or someone you know to confidently step into the world of home ownership. So without further ado, let's dive into our conversation with Elizabeth. Get ready to gain insight, debunk myths, and discover the strategies that could redefine your path to becoming a homeowner. Liz, welcome to the show. How are you today?
I'm great, Marianne. Thank you so much for having me here.
Good. I want to dive right in. First of all, listeners, I met Elizabeth Parris a few years back. She was a mortgage loan officer with M&T Bank, and we did business together. And now she's with Movement Mortgage, and I want to have a little discussion with her about the things that you guys need to look out for first-time home buyers when you're ready to get a mortgage or ready to start searching for a home. So Liz is here, and I want to just dive right in. And my first question really is, well, it's not really a question. I just want you to briefly describe yourself and your experience in the mortgage industry.
Oh, well, thank you. And yes, what a journey it's been. M&T Bank was 4 years ago, 4 years ago at this
Wow.
point. So, and I've been a loan officer now, senior loan officer. We're 7 going on 8 years. It'll be 8 years next year. So I've had a lot of fun in the market, learning, helping various families buy homes, first time home buyers, repeat buyers, investors. It's been awesome for me. It keeps me on my toes. I can tell you that much.
I can imagine.
In regards to just what helped me become interested, I've always had a passion for people. Always. My previous career journey was in the medical field. I was in medical school. I was working in inpatient, outpatient psychiatry. I was, doing a little mental health work. And that involved a lot of talking, presenting, game planning, and critical thinking with clients and people. So, when I made the transition in careers, that passion for people didn't stop. And I was just able to apply it in the mortgage industry realm and still help people with their mental and emotional needs, but around buying a home, securing a roof over their head. Because honestly, if you don't have a roof over your head that's yours, it's secure, that you can count on being there, that actually causes a lot of challenges for a lot of families.
Sure, absolutely. How did you get interested in working with first-time home buyers?
Naturally, that's where I gravitated to in the beginning of my career, and I would say more so my career once I got outside of working at a call center. I started my journey in a call center with Freedom Mortgage, and I was working with refinance. And it's when I started working at the bank, due to their programs, the focus really shifted there with first time home buyers, and it just kind of took off from there.
Okay. All right. This next question I have is on understanding mortgages, and it's a 3-part, but I think I'm going to ask you one at a time, okay?
Sure.
What are the key factors first-time home buyers should consider when choosing the right type of mortgage for them?
I mean, the number one factor is, do you have a strong enough credit score? There are several different financing options for clients to use when trying to buy a home, especially their first home. And often some programs are a little bit more strict than others. One of the more flexible programs is FHA. They have a lower credit score requirement, and that, at minimum, you can buy with a 580 under FHA. However, as I always tell my clients, stronger credit score, gives you better terms and better expenses and a better interest rate. So pay attention to what programs are going to match your credit score, your financial needs, as well as what's going to allow you to have the best monthly payment for your budget, the best cash to close for what you have saved, and what allows you to utilize as many programs as possible in regards to down payment assistance or grants. Those are the things that you need to think about in regards to the mortgage option.
Are there specific mortgage programs designed to assist first-time home buyers? And could you explain a few of them if there are?
Well, I'm going to say this. All mortgage options, and I'm just going to list a few, FHA, which is a one financing option, Veteran Association or VA loans, USDA, which is a rural loan, or conventional. Those are all mortgage financing options that can be used for first-time home buyers. What is very specific, though, is if the lender you're working with has grant programs in-house that can be used for those type of financing options, or have access to state or local grants or down payment assistance programs that can be used with those financing options. So there are always loans, the FHA, VAs, USDAs, conventionals. Those are for first-time home buyers and repeat home buyers. The better focus is what grant or down payment assistance programs does the lender you're working with have in-house or access to in the state that they are working or operating to help you buy your first home. And that's often the question that most buyers don't always ask, because there's a lot of down payment and grant programs, and not every lender has the same program.
Okay. And you said FHA, VA, rural, and conventional. Can you briefly explain what those 4 different mortgage tools are?
Absolutely. I'm going to start with the first 3, and the reason why is because they're all government insured loans. FHA loans, Federal Housing Association, VA loans, Veteran Association or Veteran Affairs, and then USDA. Forgive me, I never remember what USDA absolutely stands for, but those are 3 government insured loans that allow first-time home buyers to buy. FHA can be used to purchase anywhere. Minimum down payment, or how much money to put down on that, is 3.5%. And it's very flexible in credit score. As I said, minimum credit score required for that program is 580. And to be quite honest, it can go a little lower depending on program options. But stronger credit score, better outcomes financially. And that's just FHA, HUD insured, HUD back loan. Then there's the VA loan, which is for our military folk or surviving spouses of military. That's 100% financing, which means no money down. You also don't have any mortgage insurance for VA loans as well. Yeah, no mortgage insurance.
That's a big savings.
That's a huge
savings. That could be over $200 a month or more.
Depending on the size of the property, loan amount, where you're buying. Absolutely. That could be, sometimes that's $600 depending on the type of property a month. So it's phenomenal that VA loans don't have mortgage insurance tied with them. The other, and again, 100% financing. The DTI requirements on VA loans, meaning your debt to income ratio, also has more flexibility. Sometimes you can be as high as whatever you can be approved at. That's a huge note, because a lot of veterans have additional income, disability that they're earning. So there are other factors that help you qualify for that loan. So I've gotten people approved with debt to income ratios as high as 65%, which is unheard of.
That is unheard of.
But for VA loans, it all depends on the full package, how much money you have saved. So that's a VA loan. Then USDA loans are the rural loans, meaning you're buying farmland. You're buying in an area, you're buying farmland, or you're buying in an area that has a population less than 50,000.
Mm-hmm.
And that's typically when you're outside of the cities. You're living in the counties, you know, you're a little bit further out. You may have a PO box instead of an actual mailbox where you can get your mail. That's how far out you may be. USDA loans are a little are income restrictive, meaning you have a specific household income based on size, and then they're paying attention to how many adults in the household are working and bringing income, how many senior citizens are living there, getting retirement. So that's an interesting restriction that they have for qualification, and it's going to be based on the area as well. You may need a minimum score of a 640 for that one.
Mm-hmm.
Whereas FHA and VA loans, again, you can go down to 580, sometimes lower, but USDA loans are restrictive on credit score, minimum 640. They are restrictive on household income.
Okay.
And you have to be mindful of assets that you have saved. And that also can be 100% financing as well.
So why would somebody want, okay, I can understand maybe a USD loan for if you want to buy a farm. But what if they want to buy a house in a rural area? Would
You can
they
still
have
use
to
it for
use,
that. You can use USDA
and why
for that
would
as
they,
well.
and why would they use a USD loan versus a conventional or FHA or anything like that? Is there something about, do they have wells or something? Is that what it is?
There are just different rules when you get that further out into the county. There may be
Okay.
wells, there may be maybe less comps as well, meaning there are less properties that have sold in the area.
Mm-hmm.
There are other restrictions that happen with like land ordinances, zoning. There's a
Okay.
lot of layers of things that may come into play that FHA can't do, the VA can't do, and conventional can't do. And a lot
Okay.
of times it's how the area is designated, zoned, any type of nuances in where wells, tanks in the ground. There's a lot of different things. So that may be why USDA is actually reasonable. Also, if it qualifies for USDA because it doesn't have enough population, it's less than $50,000, and I'm sorry, 50,000 people, and also it's 100% financing, and it's accepted. That 100% financing part is the key.
Okay.
That allows for a lot of flexibility and purchasing power.
Okay.
So it's an option.
Okay.
A strong
I
one.
want to talk to you about the programs that you have at your mortgage company, Movement Mortgage, correct?
Movement Mortgage, yes.
Okay. What grants are currently out there for first-time home buyers, grants or assistance that's currently out there that can work with the programs that you guys have?
Oh, easy one I can start with. So in Philadelphia, there's the Philly First Home Grant, right? Up to $10,000 forgivable second lien after 15 years. We have a conventional grant called MMCA up to $8,000 that you can pair with that Philly First grant. So now you're already talking $18,000.
Oh, wow.
Together for the purchase on your first home. And to be quite fair, if we have a married couple and one of you is maybe purchased a home before and the other is a first time home buyer, you can still take advantage of that conventional grant.
That's interesting. Even though that's really, really interesting. So wait a minute. So you're saying, like, for instance, the wife, say she already bought a home. It's in her name. Her husband, the loan is not in his name.
Nope.
And what about the house? Can the title
Nope.
still?
He can't be on title and deed.
Okay.
He has to be purely a first time home buyer.
Okay. So the loan is not in his name and he's not on title, but he's married to the woman who owns a house of her own. If they decide that they want to buy another house and they use him instead of her, she won't be on the loan, right? And
No,
she won't
can
be
go
on
on a loan as long as he's a first time home buyer. Only at least one person on the loan has to be a first time home buyer.
Oh,
for
nice.
that grant. And if you can qualify for it together, then you both can purchase. He's a first time home buyer. It counts. She doesn't have to be because he is.
Oh, nice.
And now you have the opportunity to take an additional up to $8,000 and pair that with the Philly First grant.
Wow. Okay.
And and it all depends on who you use for housing counseling. There are other housing counseling agencies that have their own in-house money that they may be able to give. So that could be potentially one of them that I refer clients to is Urban League of Philadelphia. They have almost another up to $4,000 to $5,000 that could be utilized. So imagine that you're getting $10,000 from the city, $8,000 from Movement Mortgage on this conventional product, and then also another almost $4,000 or $5,000.
What's the eligibility requirements on those? Do you know?
So those are going to vary. They do based on zip code location, as well as household income. And
Okay.
it's more so household income of who's on the application. So it all just depends.
Okay. All right. So it'd be good for them to go to housing counseling so they can learn something about the different programs that are out there.
Absolutely.
Okay.
Learn about the programs, learn about how to take care of that. But that's just one program that Movement Mortgage has. And that's called our MMCA program. Again, that's up to $8,000, $7,500 in grant, $500 in appraisal reimbursement, which is why you get a total of $8,000.
Very nice.
Yes. And if you can qualify for that, then that allows you to purchase anywhere and there's no income limit. That's the other good thing about that program. There's no income limit.
And that you can purchase anywhere.
Right. So if you're leaving Philadelphia, but you live in Philadelphia and you live in a qualifying area, you decide you want to move to Georgia, you can use it in Georgia. You decide you want to move to Arizona, and you qualified for it before you can use it in Arizona. You're not limited to wherever you want to buy.
Okay. All right. Did you hear of any recent changes or updates on any of the government grants or assistance programs lately?
Not as of yet. Everyone still has funds available. Everyone is kind of still rolling out. The market has changed a little bit. So, the funds are not depleting as quickly as they have in the past.
Okay.
And that's a MMCA grant. We have something called Movement Boost, which is a down payment assistance program. That is 100% financing FHA program.
Wow.
Now, right. That part. You can get up to a 5% second lien down payment assistance, FHA. The income limits on that are extremely high, like 160% of the average median income. That's a lot of room. You are limited to buying max you can buy is a duplex. It is pretty comparable to the state program KFIT, but we are a little bit more flexible in debt to income, meaning you're not limited to 45%. We can go up to 55% DTI. Okay. And you can still qualify to get that assistance. We can't couple it with Philly First or any of the state programs because of deed restrictions. However, if you have an employee grant, IDA savings, using any local housing counselor grants, we can always layer those that way.
Okay.
But
it sounds like
sorry.
Go ahead. No, go ahead.
What were you going to say? 100% financing on FHA, though. You really can't beat that.
You got some good programs. So a buyer could contact you, and after they've talked to you, I guess you're able to show them which one of these programs is best suited for them based off of what they're trying to do and based off of their needs.
Exactly.
Okay. Because in some cases, people do have money in the bank, and they might have a significant amount of money in the bank. So some of these programs won't be accessible to them because they won't be eligible.
I would say that's definitely going to be a big play for state programs. I know KFIT or PHFA has a limitation on how much assets you can have in the bank. My in-house programs don't have that limitation.
All right, that's good to know. This part is really important, and I always try to talk about this every opportunity I get, because I've had situations where buyers were in the process of buying a home and they blew it because they did things that they shouldn't do when you're going through this process. And I want to reiterate that. I want to talk about that a little bit more. So talk me through the process. When somebody gets a pre-approval, what do they have to do? And what paperwork do they have to have? And what are the things that they should not do while we're going through this process until they get the keys to their new home?
Oh, my favorite question. So first things first, when I as a lender take a look at a client's file, I am doing something called a hard pull on credit. It means I'm going to get all 3 credit scores. I'm going to look at the full credit report, and I do a credit review for all my clients. I go through it, say, hey, here are the things that I see that could be a potential problem or challenge. If everything looks great, then I'm going to look at your 2 months of bank statements to make sure you have proper savings, and also make sure there are no large cash deposits that have gone into the bank account. I'm going to look at 30 days of pay stubs. I'm going to look at your 2 years of W-2s. And depending on your type of income, I'm going to be looking at your tax returns as well, just to make sure there aren't any businesses with any write-offs that cause a negative impact to your monthly or yearly income, making sure that just things have to look right, and we don't want it to pop up later in the process. But I'm looking at all that documentation. I'm looking at your credit report. I'm looking at your savings to make sure that we have a strong file up front.
Okay.
That's what I'm looking at front. What you should not do when going through this process: you should not quit your job. Please don't.
Please don't.
If you're going to transition jobs, you got to let your loan officer know so we can walk through any potential challenges. Don't make any major purchases. Don't buy any cars. Don't max out any credit cards. Don't start putting things on layaway or at Rent-A-Center because you're anticipating buying a home. Don't drop large cash deposits into your bank account that we can't source.
Right.
And often that means putting in greater than 1% of the loan amount into your bank account.
Okay. So basically, they must have a paper trail if they're going to put some deposits into their account.
We have to know where that money's coming from. Is it coming from retirement? Is it coming from stocks? Is it coming from paycheck?
Is it a gift?
Is it a gift? And honestly, also with gifts, if you're going to get a gift, make sure you let the person who's giving you the money know that we have to review their financial information as well. So make sure that they're not giving you a cash gift because we can't
accept that.
Force it.
Okay. Okay. All right. That's good to know. And I talk about this too because I've seen it happen. Listeners, if you are a first-time home buyer, trust the process. We know what's going to happen if you start doing things behind the scene and not talking to us. It's going to come up. You may know a lot about what you know, but you don't know more than we do when it comes to this. And I have had somebody do this. We were almost at closing, and she went and took out another loan. And didn't tell me, and I had already told her don't do that, and she went and did it. Somehow she thought that it wouldn't be caught, and it's going to be caught. And so that killed the deal. It was done. And I've had another situation. It was wonderful. I was so happy for this young couple. We were ready to close. We were so excited. And she opened a new credit card. She opened up a furniture store card. Now I get it. I understand why she did it. She wanted to furnish her new home. But listeners, wait until you get the keys to the house. Then you can go ahead and do that. You can buy your new car. You do whatever you want to do, but you got to wait until you get the keys to the house.
And make sure you pay your bills on time.
Yes.
That's another thing that happens.
Yes.
People miss something. They got something going on. They miss a payment. That one payment can drop your score almost 40 points, and that can disqualify you from the mortgage or any grant programming or assistance that you may have qualified for. And I also want to say on the purchase side of things, because I've noticed a lot of changes in this market since the pandemic. Even when you close, give it about 15 to 30 days before any major purchases or changes to credit. We're still monitoring credit.
Oh, so scratch what I said earlier. Wait a month after you get the keys.
I'm telling you, the house isn't going anywhere. You now own it. It's okay. Take your time. But we're still monitoring credit well into 30 to 45 days. Often.
Why is that? That's new.
So, it is new. The reason why is investors. Even though at Moving Mortgage, we service all of our loans, and we service about 70 to 80% of our portfolio. So we have a servicing department. We're servicing those loans, but all of our loans still get packaged to go to the investors. Fannie Mae, Freddie Mac, HUD, the VA. They all are the investors that every mortgage company ships their loans to invest.
Okay.
They are auditing these files now in an aggressive manner. And because of the pandemic, they're very concerned about clients' spending habits or affordability. So that's why I've noticed the monitoring patterns have increased, where you used to say, oh, you closed, you're fine. Go do what you want to do. Not anymore. Not anymore. If you get a flag,
So what would they do if they find out that this person now bought a large purchase within that 30 days of buying their home?
So there's something called a buyback. And that's when investors say they will not purchase loans from a lender. It is the equivalent of a lender having a repossession.
Oh.
Never heard of it, right? This is definitely, and it's absolutely a new thing that has been occurring. So buybacks are when our files get audited by investors, and they say, "Hey, there are certain things that we don't agree with in alignment. Like it's too much risk now, so we're no longer going to purchase this file from you or these set of files from you." And that means we have to take the file back, and that also means and any profits that were to be made off of that file are no longer going to be made.
And so, what are they going to do to the buyer?
So for the buyer, often, depending on the type of deal, you may get a notice in the mail about your file not being insured or not being accepted. And that can cause challenges for servicing. But it's really a huge issue on the lending side of things for us. And so often that can result in loss of employment for a lot of people.
Oh, wow.
So we
That's serious.
That is serious. So we like to make sure clients are, just be mindful, but also if you don't qualify for it and an investor's not taking it, there are other issues that come up for the client later in the servicing realm of things that may change some of the terms that are allowed to be flexible. So no, your rate may not change, but now we have there may be a payment difference. Something can change and it can be a challenge. So I like to stress, give it 30 days.
Okay. All right. All right. So you guys heard it. Yeah. Yeah. And we want to keep you employed too. So listeners, wait 30, 45 days after you've gotten the keys before you start changing something. And I guess the bottom line is the way you went into this process when you got your pre-approval and this is the job you had and this is how much you had in the bank and this was your credit and this was your balances on your credit cards, all that stuff that you went in and got that pre-approval on, that needs to remain the same. Don't change that.
Don't change it.
And then, wait 45 days after moving in and you can do whatever you want.
And the truth is, even if you need a car, you're actually better off waiting 6 months after the purchase of your home. Make 6 payments on your mortgage. Watch your credit score go up. That'll give you better terms to get a car. And you can get a better car note, or even someone can tell you, hey, you know what, go to a credit union, and then they'll be able to give you a limit on what you can purchase, and you can control your financing at that point. So it's really important just pacing things out appropriately and not being in such a rush. And I feel like that's such a huge challenge for a lot of buyers. They're in such a rush. You don't have to rush.
Right.
The home for you is going to be there. Take your time, save up your money, have some money left over. Because again, we're now in a different space in this market. Since the pandemic, things have been a little bit different economically. And it's better to have a good plan in place to make sure if anything should happen after I purchase this home, I can still afford to pay the mortgage, cover my expenses, and not stress. We don't want to be house poor. We want to be properly prepared.
Absolutely. You said something about interest rates, and so I wanted to get into that. There's different types, right? You have your fixed interest rate, you have your adjustable interest rate. And I know I came from a housing counseling background, so I used to just believe that everybody should get fixed rates, but I don't feel that way anymore. I believe that an adjustable rate is a tool and that some people can use it. So can you explain the differences between the fixed rates and the adjustable rates and what types of rates should a certain type of individual get?
Gotcha. So fixed rate, as it says, is going to be a set interest rate for a specific term of time. You can have mortgages on a 10-year term, a 15-year term, 20-year term, 25, 30. Those are your typical terms for the length of a mortgage and how long you can have it. When you're on a fixed rate term, that means the rate does not change during the entire term unless you do a refinance. So if you get locked in at a 7%, you're in a 7% from day one to day 360 if you're doing a 30-year mortgage. It is a 30-year fixed rate mortgage. When you do an adjustable rate mortgage, you have a short term of a fixed rate, meaning you can have something called a 3-1, 5-1, 7-1, and a 10-1. That means for 3 years, your rate's locked in at a 7%. By year 4, it starts to fluctuate and change with the market. So whatever the market is doing, your rate will adjust either every 6 months or every year. Okay. If it's a 5-1, locked in for 5 years at a 7%, year 6, adjust every 6. or every 1 year. I'm sorry, every 6 months or every 1 year. Same thing with a 7/1, 10/1, 15/1. The reason why you may pick a fixed rate over a adjustable rate mortgage is really dependent on what your plans are for the property, and also which is less expensive. Often
And
for a lot of
I would
clients.
think, especially right now with the interest rates being higher, I'm thinking people are starting to look into adjustable
Yes,
options.
absolutely. So some clients, a fixed rate makes more sense because financially, the interest rate may be a little higher, but the total expense to get to the settlement table is not as is more doable and adjust
Okay.
and easy for them to work with. For clients who know they're only going to be in a property for a short period of time, meaning, hey, I live here for right now. I'm on contract. I don't want to rent. I want to own. They may be in a property for just 5 years. They're looking at doing an adjustable rate mortgage. Or some of my clients who are moving up or moving down, and they're coming from a lower interest rate. They may want to do an adjustable rate mortgage because some of those rates are actually lower, but the cost to have it is a little bit higher.
Okay.
Those are the type of clients that are looking at adjustable rate mortgages versus a fixed rate mortgage. They don't plan. They understand when they want to pay, when they want to be out, when they want to refinance. They have a clearer path forward. So honestly, and it can be for first time home buyers, but you have to have a plan. You have to
Okay.
understand how this works in order to exit appropriately, because adjustable rate mortgages they're not long-term solutions. They're short-term solutions so that you're able to be flexible with your
Okay.
financing.
Okay. What do you suggest a person do to pay off their mortgage faster?
Oh, prepayment.
Okay. How
Prepay.
does that work?
So prepayment is when you take additional money and apply it towards your principal balance each month or every 2 weeks. There's no penalty to prepay.
Okay.
And that allows something called a recast to happen because you are lowering your principal balance. So all we do is just shift how many months you have left in the term.
Okay.
Mhm.
Okay. And they should specify that that payment should go towards the principal only?
Absolutely. Every
Okay.
servicing company should allow you to have the option to say, hey, I want to put an additional 200-300 towards my principal balance.
Okay. All right. I want to go back to, we were talking about the requirements, what the process looks like when you're actually going for a mortgage. Because
Mhm.
there was something that we left out, and I really want to address it.
Absolutely.
Listeners, I just want to let you know that underwriters are human.
Mhm.
And while they have a professional job to do, they can get prejudiced towards you depending on what your paperwork looks like. So, what are some of the things that the underwriter asks for?
So I'm looking at your, again, 1 month or 30 days of pay stubs. I'm
Mm-hmm.
looking at two months of bank statements.
Mm-hmm.
If you have a retirement account, I'm looking at the most recent statement for your retirement account.
Mm-hmm.
I'm looking at your 2 years of W-2s, 2 years of full tax returns, all schedules, all pages.
Okay.
Often I'm reviewing that up front to eliminate any challenges that could come up with the underwriting process so we can work them out up front. And I'm looking at your credit as well. What I see underwriters asking for sometimes, and this happens when clients move too much money around between accounts or they have a lot of cash deposits. So even though those cash deposits may be small deposits, when you have multiple cash deposits into a bank account within a 30-day realm, I have seen underwriters add them up. And if they
Mm-hmm.
exceed the threshold, then you're going to have to explain where did they come from, or they may have to back out those funds altogether from your assets. So that
Okay.
happens a lot. Inconsistent banking, a lot of movement of money, too many deposits coming in from, Cash App, really, not so much Zelle, not so much Venmo, but Cash App has been the one app that's given all of us a run for our money when
Okay.
it comes
Okay.
to bank statements.
Okay.
Another thing that comes up for my clients who work hourly, and they say, yeah, I work 40 hours a week. I get the pay stubs, and two pay stubs say 40 hours a week, right? Cool, adds up. Then I get one pay stub that's showing that's a little short on those 40 hours, and there's no PTO to cover it. that causes something to happen with your income calculation. We go from a fixed set income calculation to something called variable income.
Mm-hmm.
And variable income means my underwriter, and I do look for this up front, but my underwriter is now going to average your income and your hours over a 2-year period or 12-month period, depending on when you last received a raise. That can change what you qualify for and your debt to income ratios drastically because you don't consistently make 40 hours. And if you don't make the consistent 40 hours, you don't have PTO to cover it. That happens a lot.
Okay. When I started with the underwriters are humans, what I'm basically saying is make sure you give them a clean package, easy for the underwriter to understand. If you have several bank accounts, prior to going into wanting to buy a home, settle on a couple of them and stop moving your money from bank account to bank account because they have to source all that. So now you're making them work extra. And like I said, they're human. Okay.
And I'm also going to say, not to even cut you off, I'm looking for that up front. So if you're like, hey, I really want my pre-approval letter now, I'm going to say, I looked at your file and I asked you for some clarification. I'm not issuing a pre-approval letter.
Okay.
I have to work with the underwriter directly. My processor and my assistant have to work with underwriting directly. It's a bad situation for all of us. And I've been there with clients where things are not clear or something comes up and it can slow up your process and keep you from closing on time. We don't have we're just not in the market now where we can risk those type of delays. So often I am gathering all these documents up front, reviewing them. Sometimes I'm sending them to the underwriter to approve them so I can issue a pre-approval letter. So that way we have all of the kinks worked out first.
How can buyers improve their credit score?
Sign up for free monitoring.
Okay.
And if you can't find free monitoring, there is a low-cost monitoring through Equifax.
Okay.
It's about $40 a month.
Okay.
You can monitor your credit that way. You get your credit scores every 30 to 45 days. Start looking at your credit score. Start looking what's on your credit. Pay very close attention to collections that may pop up, accounts that may be opened that were unauthorized. You can also freeze your credit score through some of those apps online through the bureaus. So you can make sure your credit is protected until you're ready to go through the mortgage process. Okay. That's 1. 2, sometimes people don't have enough credit history. Secure credit cards are a very good way to build credit history. You don't have to do a hard inquiry on credit. You have a $200 to $300 credit card, that money that you put on that card deposit. It's a very good way for you to, again, build credit history, pay on time, keep those credit card balances 30% or lower of the limit.
Yes.
Because that is a huge, utilization is a huge issue. And that's what lowers your credit score. So please pay and keep your credit card balances 30% or lower of the limit. Which means if you got $1,000 limit, your credit card balance shouldn't be more than $300.
Okay.
Pay your credit card by the statement date, not the due date.
Why is that?
Around the statement date is when they typically report to the bureaus.
Oh,
so if you paid a couple days ahead, now your credit card is at a lower balance, and the bureaus are the credit card companies are gonna report that balance to the credit bureaus. Okay. Often that is showing a lower utilization, which helps your score go up.
Okay. I know another thing people should be careful about is inquiries. Getting new credit or just inquiries, period. And some people will be like, well, I'm not trying to get a new credit card. Do you know how they get you? When you're at a basketball, football game, and they say, well, you apply for this credit card and you can get 20% off of some of this paraphernalia you can buy. You know, that right there will lower your credit scores.
That 20% won't help you get a better interest rate, so just leave it alone.
Yeah.
But I will also say they get you store credit cards are another thing.
Oh yeah.
But also if you know that you are looking to buy a home in the next year or two, and you may be thinking about getting a car, don't get the car.
Yeah.
Don't get the car. Just wait on it.
You're right.
Ride the bucket, the putt, whatever's going on with it. The 97, 98, 2002, whatever it is. If it works and it runs, hold on to it till after you go through the housing process, especially if you're trying to buy in the next year or two.
Okay. Okay. How should first-time home buyers financially prepare themselves for a mortgage?
Start saving now. I always tell clients, don't wake up tomorrow and say, okay, I'm ready to buy a home, and haven't looked at credit, haven't looked at savings, haven't done anything to really educate themselves. Start looking for home ownership counselors now. If you know you're interested and you
Mm-hmm.
haven't really taken a
Mm-hmm.
look at your credit in the last year, go to a
Mm-hmm.
housing counseling agency. They do a soft pull on credit. They will do a financial review with you, and they will walk you through any type of programs that you can use to save money if you don't have enough savings. But start saving. Start putting $200-$300 aside
Okay.
every 2 weeks now, so that you start
Mm-hmm.
getting in the habit of discipline and saving. Um,
I think that's great information.
there's so many savings programs that are available to first-time home buyers. And they're called IDA match programs, where you
Oh
save
yeah.
$2,000 and they give you four. Sometimes your employer has them. Sometimes you're $1,000.
My.
And those programs typically run for about 90 days because they want you to build up the saving habit.
Where would they get an idea? Well, their employers would have that.
So employers have it. You can look up something called achievability. You can
Oh
literally
yeah.
Google IDA match, and it'll pull
Okay.
up all of the agencies that offer it, because there are multiple agencies that offer it. I just know achievability. There's some women run organizations that are focused on single mothers. There's a
Mm-hmm.
lot.
Okay,
There's a lot.
that's a great nugget. Listeners, buyers, you hear that? If you're thinking about buying a home in the near future, Google IDAs and see if any of them apply to you, so that you
Mhm,
can start saving, but not just save, get additional money from this program. I think that's wonderful.
mhm.
What are some of the common challenges that first-time home buyers face um, when trying to finance their first home?
Not
Okay.
having enough money saved. And I want to be clear that also your 401ks are considered savings.
Okay.
So
Mhm.
if you've
Mhm.
worked at a job for 5-10 years, whatever you paid into your that 401k can be used to buy a home. A lot of buyers I've recognized don't know that. So I want to say that because it's also important. Um, but savings is the number one thing. Not having enough money in the bank, not having enough money saved or left over is a challenge. Then the second part really is credit. Um, Not monitoring credit, not being on top of late payments, collections that hit your credit, um, co-signing for family members for things you have no business co-signing for, and that's my number one rule.
Can I speak to that real quick?
You
Because
sure
I
can.
used to tell people all the time that monitoring your credit, making sure there's no new collections. And I would say, do you have any old library books out? And they were like, well, why? Because they will put that on your credit report if you don't take it back. So
Hmm.
you're right.
Listen, utility bills pop up a lot.
Mm-hmm.
Verizon, Pico, PGW. You're on a lease with an ex, and one of y'all had the utilities in the name, and you were taking care of one thing. Y'all separate. Now y'all in two different places. You got a whole
Mm-hmm.
collection for a gas bill
Mm-hmm.
sitting on your credit that you didn't know was there, and that's bringing your credit score down. Um, what else?
I want to make sure people heard you because I talked over you for a second. She said something about co-signing loans.
Oh, don't co-sign. I don't care if it's for your mother. Don't do it. When you co-sign, you are agreeing to pay someone else's debt until that debt is paid off. Car,
Mm-hmm.
house, whichever. It's like lending money you don't have.
Yes.
Do not co-sign. If that person makes a late payment, you're liable. If they're not paying on time, that's not a debt that I can eliminate from the process. That's what I want to be clear about. Like, people who co-sign, I'm paying attention to, did they make the last 12 months of payments on time? If they did not, that can keep you from qualifying from getting certain programs as a first time home buyer. So don't co-sign.
Mm-hmm.
I'm sorry. I get it. I
Mm-hmm.
know. If it's your mama, tell your mama you love her. Can't do it.
Okay.
Can't do it. And then lastly, the other part about this is also just, and it's something that you can't really control, but it is something I'm very big about going over with clients. Mindset. Mindset is the biggest part of
Mm-hmm.
one of the biggest parts of trying to buy a home. And often clients keep hearing, oh, I could have a mortgage for this amount, or I could have this interest rate because I heard that, all these things. Or people keep thinking, oh, I don't know if I'm ready, or I don't know if I'm prepared. And a lot of times it's sit down with a professional. Let's go
Mm-hmm.
over your file. Let's go over your income, your credit, and let's make sure you're prepared for what this means and understand that it is possible, but it may require certain steps and it may require a
Mm-hmm.
longer timeline or shorter. But
Mm-hmm.
you got to be in the mindset of ownership.
Right.
There's no
Right.
one else to call to fix things in the house. You can't want to go on a trip to the Bahamas and want to be able to buy a house within the next 30 to 45 days.
Mm-hmm.
You have to properly plan your next steps in order to buy the home and then maintain the home after you purchase.
Yeah, you're right about the mindset. It's got to be something that you really want because it's not an easy process.
No.
And it's very challenging. And, when you're dealing with the lender, and I know I used to get so frustrated, and now I know better, but I used to get frustrated. And most buyers do when you're dealing with the lender and you're like, well, I already gave them 2 weeks pay stub. And you feel like they keep asking for the same thing over and over again. And my thing is, so what? Just give it to them over and over again. Because the bottom line is you're trying to get to that table and buy your home. So just do what you have to do. And I'm sure there are reasons why you have to send that pay stub more than once. A lot of it has to do with time has gone by and you have to just keep updating it.
Mm-hmm.
Sometimes things get misplaced. Okay, then send it again. Whatever you got to do to get to that table, that's what you do. That's if your mindset is really set on buying a home. I had one girl tell me that she got tired of jumping through all the hoops before she got to me. And I told her, everybody jumps through hoops to buy a home. This is the process. And then she said, well, I'm going to tell you right now, if they ask for one more thing, I'm not buying this house. I said, don't buy the house because your mind not ready for this.
Listen, the mindset has to be there, and understand that, one of the biggest fears right now is interest rates and monthly payment. And it's
Right.
the fact that the economy is more expensive. And I'm often telling clients, listen, it's always a good time to buy as long as it makes sense financially, but
Mm-hmm.
understand that the rates eventually will adjust and come down. But the
Mm-hmm.
housing prices are going to continue to go up. So if
Mm-hmm.
there's a good deal that you have found, then let's sit down and go through those numbers and make sure it makes sense for you. And then focus your mind on, this is a temporary situation. I will be able to refinance as long as I qualify and be
Mm-hmm.
able to lower my monthly payment. I'm not going to be stuck at the higher interest rate or the higher monthly payment. But you are
Mm-hmm.
marrying the home. You are
Mm-hmm.
dating the rate.
Right. Oh, I like that. Okay. Okay. And you're right. Anytime, anytime is a good time to purchase a primary residence. Anytime. Okay. Because yes, rates are higher, but when they go down, you can always refinance for a lower rate. But the bottom line is, can you afford those payments? And yes, house prices are going to go up because that's just the nature of the beast. However, right now, what I'm noticing, because the rates are high, there's not a lot of buyers out there right now. They're thinking, well, I'm going to wait until the rates go down. So what's happening is the sellers are a lot more willing to work with you now. They're
Mm-hmm.
even willing to negotiate on the
Mm-hmm.
sales price and all kinds of things. So don't sleep on this. If you want to buy a house this year, then go ahead. Don't let the rates stop you from buying a home. Rates should never stop you from buying a home.
Absolutely. And I want to be clear. The minute the rates shift down and it's a little less expensive to finance, you're going to bring more borrowers into the picture, which is going
Mm-hmm.
to bring up the competition for the homes. And one
Mm-hmm.
thing that has not changed is the amount of homes available. That's
Mm-hmm.
still very much so a limited inventory.
Mm-hmm.
So if you are in a position to buy and you are serious about buying right now,
Now it's the time.
now is the time. And maybe you also need to talk with a lender that may have more options for you, because maybe you're not talking to a lender with options.
Right. What essential tips can you offer first time homebuyers to make the process smoother and less stressful? And can you share a success story of a first time homebuyer you've assisted, highlighting key lessons other buyers can learn from?
Absolutely. So I'm very big on preparation. Get organized early and get everything to your lender or loan officer within 24 to 48 hours.
Mm-hmm.
The longer it takes you to get us documents, the longer it takes us to look them over and issue pre-approvals, the longer it takes us to get your loan closed when you are under contract. So if you were thinking, even if it's a small inkling in the back of your mind that I may want to buy a home, start gathering those documents I went over earlier. And just in case you don't remember, 30 days of pay stubs, 2 months of bank statements, 2 years of W-2s, your full 2 years of tax returns, your most recent retirement statement if you have one. Okay. Early.
Okay.
Success stories now.
Yes.
I got plenty. But here's what I'm going to say. I had one client. She came to me. She thought she was going to buy in a year and a half. I said, okay, well, let's take a look and I'll let you know what's going to be what. I looked through her information. I looked at her income. She got me everything with 2 hours, actually. She was very motivated.
She was good, yeah.
She was very, very motivated. So I didn't have to worry about that part. She got everything over to me. I went through all of her documents. I looked at her credit and I said to her, here's your pre-approval amount. You actually can go look today. Here are the grants that you're going to be able to qualify for. She was like, wait, what? I was like, yes. You can go look today. I'm pretty sure that in about 90 days, you're going to probably be closing on a house. Wow. This was last year. I got her pre-approved early mid-May. By August, she was going to settlement on her home. And we had layered about 2 grants together for her. So her out-of-pocket expense on this particular deal, it's not the case for everybody. She only maybe had to bring $1,000 or something to closing.
Isn't that amazing? Mm-hmm. Now, if she was trying to get an apartment, what would she have to be bringing? 3 months in advance?
3 months in advance.
And let's say it was a $1,500 a month apartment. What is that, $4,500? Mm-hmm. I mean, that's amazing.
I mean, in the city of Philadelphia, to have just, I think now for a two bedroom, 1 bath, you're talking almost $1,800 sometimes, depending on where you're living in the city. But I want to be clear. She was a client who thought she had to wait a year.
Isn't that amazing?
Her, at this time, this is a year ago, so she was getting a 4.7, 4.8 something interest rate at the time. She thought she had to wait a year, almost a year and a half before she would be ready. It was us having that consultation and looking over her documents. I said, oh no, you're actually ready to go sooner than that. And I laid it out for her. So because she was organized, she wasn't afraid to have the conversation. She responded quickly. We were able to work quickly and find her a good situation. Those are the 3 things I could take out of it. She was organized, she was motivated, and we were able to layer those grants. So she was open to it, and we moved sooner than later. So instead of a year, 90 days, not even.
I like that. Did she have any idea what her credit scores were already?
She had an idea, but she hadn't pulled it. She had an idea.
So what made her think that she wasn't ready?
I think she was under the impression that she needed to have more money saved because she thought she had to put down a larger down payment.
That happens a lot. You know, that happens a lot. They have good credit and everything, good job, everything, but the person may think that they have to have more money, and they have no idea. There's programs for them.
Exactly. And she didn't have to have more money. So for her, she thought, I need to save more, and then maybe I'll be ready once I can save all this money. And I was just like, you don't need to save all that money. And the thing is, she also had retirement. She didn't know she could use her retirement. We didn't have to use her retirement, but I was like, you have retirement. You actually have what you think you have to save is sitting in retirement, but we don't have to use it.
Yeah, the retirement funds was the qualifier, but she didn't have to use it to actually close on the loan.
It gave us some assets and it gave us additional savings, and that made her file stronger. And when I ended up looking at credit, her credit was very strong credit score. I was like, okay, you were just scared. She was in her own head about it instead of having the conversation. So, her realtor was like, hey, talk to Liz. Liz will get you organized and put together. And 30-minute conversation, pre-approval, and 45, maybe 60 days later.
That sounds good. That sounds good. So listeners, if you want to buy a home, but you're not sure whether or not you're eligible or you're not sure you have enough money, talk to somebody who can help you. In fact, I strongly suggest you talk to Liz. In fact, Liz, how can my listeners get in touch with you?
Oh, absolutely. So if you are on social media, because I know it's a huge thing nowadays, you can find me at medicine, the number 2 mortgages. Again, that's at medicine, the number 2 mortgages. You can email me, elizabeth.parris, Parris, at movement.com. You can call me or text me before 7 p.m. though. 856-295-2442.
Okay. Do you have any final words that you think our listeners should hear?
It is possible to be a homeowner. It is absolutely possible to be a homeowner. Do not let the economy, do not let all the news, gloom and doom, make you think it's not possible. It is absolutely possible. You need a plan and you need some discipline.
And there you have it, folks. What an insightful conversation we had with Elizabeth Parris. I hope you found Elizabeth's expertise and practical advice as inspiring as I did. Whether you're an aspiring homeowner, a first-time buyer, or a small business owner looking to navigate the financial landscape, Elizabeth has provided a wealth of knowledge to guide you on your journey. As we conclude this episode, remember that financial well-being is a continuous process, and taking control of your finances is the first step towards achieving your goals. Elizabeth has shown us the way, and we encourage you to explore her services further if you're seeking expert guidance. A heartfelt thank you to Elizabeth Parris for sharing her wealth of knowledge and providing us with valuable insights into mortgages, grants, and loan programs for first-time homebuyers. And to our dedicated listeners, thank you for joining us on this enlightening episode of MH Knows, or She Knows Someone Who Does, Unlocking Real Estate Secrets. I am committed to continuing this journey with you, bringing you more real estate and financial wisdom, and introducing you to experts who truly understand the intricacies of their field. If you found today's episode valuable, please don't forget to subscribe, rate, and leave a review. Your feedback helps me continue to provide you with quality content. Until next time, this is Marianne Holt signing off and reminding you that when it comes to purchasing your first home, knowledge is the key to your success. Stay curious, stay informed, and remember, MH knows, or she knows someone who does. Take care.